Hello everyone, welcome back. We are here at IMN Single Family West doing a live version of our December market update. Rick, great to see you in person.
You as well.
And we have Omar from RCN Capital.
Nice to be here.
Oh, this is going to be great. Virtual is cool, but this is way better.
Yep.
And look what we got going on here. Not bad for December.
No.
So, Rick, the energy in the room this morning was really pretty good. Investors seemed very optimistic. I keynoted the finance panel this morning. Lenders seem to be very pleased with where the liquidity positions are in the marketplace. Money for investors to buy assets, although still some trepidation about the amount of assets in the marketplace. What's your read been so far this morning?
Yeah, I think you summarized it pretty well, Jeff. The energy level here is very strong. I think the net of all of this is that people investing in rental properties, single-family rental properties, do see continued market opportunity. That's one of those good news, bad news things for the housing market writ large. It means there are probably millions of people who would otherwise like to buy a house, who simply can't afford to right now because of that. They're renters for some period of time. But it was interesting to hear the lenders talking about the quality of the borrowers, the quality of the assets, the relative certainty they seem to have about the capability of the borrowers to make good on the loans and future market opportunities as well.
You know, one of the things that was a big takeaway for me from my panel this morning was the conversation about the institutional nature and the way our funding partners, the partners who are owning this long-term debt, the insurance companies, the hedge funds, the securitizations. It was very interesting to me, and Omar, you could certainly chime in on this, the way institutions today are looking at our product very differently than just a few years ago.
Yeah, that's actually a very good point. I mean, I've noticed, I worked for a large institutional asset manager and for a number of years, and I noticed recently, new job openings for SFR specialists. So there's definitely an interest from the institutional world. They want to participate. They want a piece of the action.
And this is a relatively recent phenomenon.
It is.
I mean, if you think about it, the single-family rental market really didn't have much in the way of institutional investors until 2009.
That's right.
Coming out of the great financial crisis.
Yeah.
And we didn't have our first REIT in the business until just a few years ago. So it's really starting to accelerate, gather some speed. And I think, to Omar's point, it really has become more of an investment vehicle for the larger investors than it has in years past. Historically, this has been the purview of mom and pop investors. Right. And they didn't get their funding from insurance companies. They got their funding from their cousin Hector.
Yeah.
And had to fund their next purchase with the cash flow from the previous one.
Right.
How much do you think the data behind the performance of the single family investment is giving comfort level to all of the liquidity that we're enjoying in the space right now?
Can you expand on that, Jeff?
Oh, sure. So some of the data that we've been seeing, not only from our institutional partners, but from the larger hedge funds that we're not working with, in other words, the Arbors of the world and folks that are writing these larger portfolio deals, the data that they are providing really seems to be giving a comfort level to the new money coming into the space.
Yeah, I think one of the reasons too why the institutional world is, has kind of a more of an interest in this space is because, multifamily has somewhat struggled over the past few years. I mean, we saw, vacancy rates increase, we saw rents drop, but the SFR story is completely different. I mean, vacancy has stayed extremely low and rents continue to climb. And so I think because of that, the economics make sense. You're starting to see that shift from multifamily to the SFR space.
Yeah. First of all, there was no data until a few years ago.
Right.
Again, even today, 90% of single-family rental units are owned by mom-and-pop investors who own 10 or fewer properties, and they're certainly not reporting their data to anybody.
That's right.
So until we had some larger or mid-sized investors come in, start working with some of the ratings agencies, which they really needed to do for their investment trusts, you really didn't have any reliable data you could use. But once people started to see what it was and how these assets performed, you could start to make intelligent investing decisions. And to Omar's point, the multifamily market, first of all, the multifamily market has decades of data you can look at. So you can use that as a bit of a proxy, sort of. But there are 1 million apartment units coming online between last year and this year. In fact, if you look at apartment completions right now, they're actually outpacing apartment starts.
Yeah, starts are way down.
Way down.
Yeah.
So it's because of this potential oversupply in a lot of markets that multifamily vacancy rates are up and asking rents are down. You're not seeing that kind of market dynamic in the single family space.
That's right.
And the other reality, Jeff, is that these large institutions are always looking for investment opportunities in either the mortgage space or the real estate space. And candidly, there just aren't a lot of good ones available right now. And SFR has been kind of a shining star in a very dark night for investors.
So speaking of data, we just completed our most recent investor sentiment survey here at RCN Capital. I have not seen the data yet, but I know you have, Rick.
I have.
Let's give the audience a sneak peek at what's coming out.
Well, in a lot of ways, Jeff, what we saw in our Q3 report mirrors very much what we're seeing here at the IMN conference. A lot of energy, a lot of enthusiasm. We created the RCN Investor Sentiment Index a couple of quarters ago, and the index is off the charts right now. We had an 8-point increase quarter over quarter to the highest positivity results we've ever seen. So about 2/3 of the investors who responded to the survey said things were much more positive today than they were a year ago. Almost 3/4 expect things to continue getting better in the next 6 months. So the level of optimism is just off the charts. And I think it probably has a lot to do with changing market conditions. There's more property available to purchase now than there has been in many months. Home price appreciation is slowing down. The one asterisk I'll put on this statement is that we took the survey at about the time when interest rates had started to come down because of anticipated Fed rate cuts. And that was early September when mortgage rates dropped all the way down to 6. I'm curious how that positivity will look when we do our winter survey, since interest rates have come back up. We're all watching the bond markets to see what's going to happen with interest rates going forward. But the fall results were just phenomenally positive.
So that's interesting to me, especially, and maybe you can drill down on this, Rick, which is the lack of inventory. Yes, listing days in some markets are up, but it sure feels like there's not a lot of houses for sale out there.
There's not a lot of houses for sale out there compared to previous years. But if you look at where we are today versus where we were a year ago, the inventory levels are up about 35%. So we're coming off probably a market bottom from a year ago, but it just feels better. And I think investors who are looking for an asset to purchase at least have some more inventory to choose from. And in markets like Florida and Texas, we've actually seen a pretty significant increase in listings to where in some markets year over year values are going down.
So there's some softening.
There is some softening in the market. And those, I know we'll talk about this in a little bit, but those are also two markets probably most affected by rising insurance rates.
Right.
There must be a correlation there, right? There's got to be. That heat chart that I showed this morning had Florida just unbelievable. 43% of the monthly was insurance. Like, unbelievable.
Yeah, Florida's been the hardest hit by far. The average new policy written in Florida for a homeowner is in the neighborhood of $10,000 a year. So that's real money we're talking about in terms of your monthly outlay. There's some speculation. I've seen some reports from the economics team at Fannie Mae that we're seeing an increase in listings in states like Florida and Texas because the homeowners there can no longer afford their monthly payments. And if you think about how when a lot of people apply for a mortgage, they just barely qualify for one. Yeah. Now imagine your insurance premium doubling or tripling in a year. Imagine your property taxes going up. In a state like Texas, where home values have gone up, in a market like Dallas, 35% in the last couple of years. Well, your property tax is going to go up along with that. So now you're the homeowner who just barely qualified for your mortgage. You're looking at exponential increases in your insurance and your property taxes. And there's a point where you just can't afford that house anymore, so you're going to try and sell it before you get into trouble.
So are they selling and then becoming renters?
They're either selling and becoming renters, or maybe they're downsizing. Or increasingly we are seeing continued migration across the country as people look for a place with a lower cost of living.
I see. Okay.
It's interesting. To your question, Omar, this morning, Beth O'Brien from Encore, she quoted a stat from Apollo that has over a third of all transactions when homeowners are selling, they are not going into another single family ownership situation. They're either going to a multi or a single family rent. That to me is a game changer.
Well, it is a game changer, but it's not a huge shock when you think about demographics. We have thousands of baby boomers retiring every day. That generation has aged in place at rates that no previous generation ever did. So they've been in these houses a long time. They've amassed an enormous amount of equity. But when it's time for them to move, they're not necessarily looking to buy another house.
So they're cashing out.
And I think you'll continue to see that trend over time.
So I wonder, as we think about where the cohorts of individuals that are cashing out, how as lenders and investors in different geographies, how we start to think about that, right? So we think about Florida with insurance. Well, are we also thinking about Florida as a demographic that is cashing out and maybe leaving the state altogether?
Yeah, and that would be a huge sea change from historic trends, because when I grew up on the East Coast, we used to sort of derisively refer to Florida as God's waiting room, because people would go there to retire and eventually age out. But now, if you're moving to Florida on a fixed income, it'd be a challenge for you to buy a house because you're not sure what's going to happen with insurance, with property taxes. You're going to be able to afford to make those monthly payments for the foreseeable future. So we may see other places become more attractive retirement enclaves going forward.
So thinking about some of the other data from the RCN sentiment survey, were there any other surprises or other notes that you can share with folks?
Yeah, a lot of notes. I'm not sure there are any enormous surprises. We were talking about insurance, and I know you talked about this in your presentation this morning. But almost 80% of investors noted that the rising cost of insurance or the unavailability of insurance in certain areas was a factor in their decision about whether or not to invest in residential real estate. And again, about 2/3 of them said it had cost them a deal somewhere along the way, that they actually couldn't execute a deal because of these costs or because they couldn't get a property insured. So I think just the sheer magnitude of the insurance problem manifesting itself I think it's surprising to most people, because it's insurance costs, insurance availability have never been things we've thought about either in terms of home buying or investing in properties.
Well, it's interesting because, and I mentioned this morning, as lenders, right? Like, we write on what we know. Like, we write these loans with understanding specific data points today. when you start to put a variable in that wasn't there in the past, it does give us some pause.
Oh, and you need to factor insurance costs and higher property taxes into borrowers' debt to income ratios. Now, I know in the private market, you're really looking more at the property value than at the individual borrower. But if you get into something like a DSCR loan, where it's going to be a long time hold, you probably do have to take a closer look at those costs from an operating perspective. And that could be one of the reasons, and this was a little bit of a surprise, why fix and flip investors were significantly more positive than rental property investors. I think if you look at what's going on in the rental market right now, a lot more competition from multifamily because there's just a lot of availability of inventory. Asking rents, although they haven't really gone negative in most markets for the SFR crowd, have come down significantly. Property values have been going up, so it's more expensive for them to buy. Finance costs are higher. Insurance costs are going up. Property taxes are going up. So if you're somebody sitting on an asset right now, if you're looking to buy a rental property and you're looking at those headwinds, I can see where that would. They're still on balance more positive than negative, but the fix and flip investor was just incredibly positive, and I think that also has to do with changing market dynamics and lower property price appreciation, more inventory available, and consistent demand from people who are looking for a property to live in.
Yeah, I think as a lender, you almost have to look at a sensitivity analysis to see what happens to your DSCR if insurance and taxes continue to rise, and see what that does to your debt service coverage ratio, because you can go from a positive to almost a negative, which completely just changes the risk profile of the loan. And I think operators should be doing the same analysis as well, and sponsors.
And I think it's dangerous for anybody to have a takeaway from this conversation that it's only Florida and Texas. Right. Because it's not only Florida and Texas.
Yeah, that's a good point.
Louisiana's had astronomical increases in insurance prices, but if you look across the country, if you look at the last 20 or so years, just about every part of the country has had $1 billion damage extreme weather event. Wildfires, hailstorms, tornadoes, floods, hurricanes. That's caused massive losses in the insurance industry, which is causing premiums to go up everywhere. And I think there are even some parts of the country you wouldn't expect to be high risk areas that are seeing those premiums go up just to offset some of the areas where they simply can't raise premiums any higher. So it's something everybody needs to be paying attention to on a go-forward basis.
It's interesting, as we've been talking about individual assets and whatnot, and Omar, I'll let you jump in on this. As we start to think about how investors mitigate risk, spreading assets through wider areas, how would investors think about pooling assets together instead of doing individual loans to doing maybe larger portfolios where they're spreading that risk of a specific town raising their insurance rates or even taxes, all of these things that go into things. How do we think about that?
That's exactly, Jeff, why I really like the scattered site portfolio loan, because you have assets in multiple cities, and so if you're experiencing rising interest rates in city A, city B might be performing well. So at the portfolio level, you're still doing well. And so I think by owning assets in different cities and looking for like a portfolio loan, I think doing that strategy makes a lot of sense, because you're essentially, to your point, you're spreading the risk, and so it's not focused in one specific area.
Interesting. How wide does something like that get? Because I think there's probably a lot of investors today say, "Oh, that's interesting," but they don't really know a lot about it. How wide can someone go from scattered sites?
Truthfully, there's no limit. It becomes more difficult to underwrite, but you can come to me for a portfolio loan, and you can have assets in 5, 6, 7 different cities. That's not a problem. In 5, 6 different states. So there's really no limit.
That's interesting, Rick. Have we begun to see data where our investors are beginning to jump those thresholds, maybe that they haven't in the past, to mitigate risk?
Not yet. And keep in mind the majority of people that respond to our survey are relatively small investors. And so they do tend to invest, and historically this has been true, close to home. They want to be able to drive to a property, to inspect it. They want to make sure if something goes wrong, they're within shouting distance. So for those small investors, particularly the buy and hold investors that are going to keep a property as a rental unit, they want to keep it within a relatively confined area. And every time we've asked the question, 80 to 90% of the people that respond really focus on their home state, where they live, whether it's in the same city or county or somewhere else in the state.
Yeah, it's interesting because in a state like Florida, the risk can be seriously different from a coastal to even going, 20 miles inland. I would think that investors must be looking at that today.
Sometimes you get so caught up in the opportunity that you don't look at the bigger picture. This house is a bargain. I should buy it. I can do something great with it. It's built on a tribal burial ground and an earthquake fault. I guess I probably should have looked at that too. So you really, as an investor, I think the takeaway from this is you really do need to be looking more broadly than, is this a good deal? Does this look like it's going to pencil out from a cash flow perspective at broader issues before you make that kind of investment?
So not just micro, but also macro.
Absolutely.
As we start to think about how some of 2025 is going to unfold, I know in our last update in November, we talked about some of the potential housing policies that would be coming down the road. Have we seen any beginning of a semblance of what that's going to look like going into next year?
Well, I noticed the president-elect had a meeting with Prime Minister Trudeau from Canada within a day, I think, of mentioning there might be 25% tariff on Canadian imported goods. We get a lot of lumber from Canada, so amazing how quickly that meeting took place. It's interesting you asked that question because in our fall survey, the majority of investors surveyed expected Vice President Harris to ascend to the presidency, and a higher percentage believed that she would create a better investment environment, which to me was a bit of a surprise. And I'm
that
not
is a surprise.
I'm not trying to get political here, but one candidate historically is a real estate developer,
Right.
The other one not, and so you kind of expect a little bit of a leaning that way. And the vice president was part of an administration that was talking about implementing national rent controls, national policies that would limit the number of properties an entity could buy and own, limited tax benefits for people that own more than a certain number of properties. None of that to me sounded like an optimal investing environment. So I think a lot of this probably came down to the candidate preference. I don't like Donald Trump, therefore I'm going to suggest that he wouldn't make the best environment. We haven't seen anything in terms of the current policy or the proposed policies coming into effect yet. It'll be interesting to see some of the appointments that are made. There's a gentleman now who's been nominated as the next HUD secretary, who's pretty friendly from an industry perspective. Will we see tax reforms? Will we see regulatory reforms? Will we see government lands opened up for development and building, because we need supply? And I think the fact that President-elect Trump has acknowledged that supply is probably the overwhelming issue is a good sign and an indication that if they do anything housing related, it's going to probably try and address that problem.
When we think about adding to the potential new construction, where are the national builders today? Are they still entitling land? What is their sentiment for trying to get ahead of the curve, or are they taking a bit of a pause because of the stagnation of the owner-occupied interest rates?
No, actually, the national builders have the highest share of construction in decades. So the local builders are the ones who've kind of taken a step back. Whether it's a temporary step or a permanent step, I don't know. But we've seen the national builders really account for a higher and higher percentage of the properties being built. And I'd caution people not to take at face value headlines that say housing starts are down, because they're not. Permits are actually up significantly year over year. And if you look at the starts of single family homes intended for owner occupancy, those are actually up year over year. So the builders are trying to come back, but they're not coming back with an enormous amount of enthusiasm because they got caught last time with a bunch of oversupply that really decimated not just the market, but those builders themselves. They're not going to make that same mistake twice. So what we are seeing is more targeted building. We've seen a lot of building in the South. We've seen increasing building in the Midwest. Not seeing quite as much on the West as we've been seeing in prior cycles. And there's not much going on in the Northeast, which is causing an inventory issue in the Northeast and is causing prices to continue to go up in that part of the country.
Yeah, that was in some of the data I had on my slides this morning. Was super interesting because you look at the hot markets, right? Mm-hmm. The Dallases of the world, the Austin, Miami, really Florida in general, with the exception of the Panhandle, either flat or declining in both rents and housing values. Yeah. And then you look at places on the East Coast, even our home state of Connecticut, appreciation in both rents and we're not exactly creating jobs like there's no tomorrow up there, right. But yet it continues.
Well, I live in California. I'm in Orange County. And California is kind of a microcosm of the rest of the country combined. If you look at where I'm in Orange County, there is virtually nothing available for sale, and prices keep going through the roof. And unemployment is very low. It's like something like 3.7%, so it's lower than national average. If you look at California as a whole, unemployment's almost a point higher than it is nationally. I think it's 5.1, 5.2%. You see huge swaths of California where prices are flat or declining slightly. So it really depends, to your point, on the jobs market, on the inventory of available properties, how much new construction is going on. My biggest hope for housing supply in the next year or two is that the government comes up with some sort of creative partnership opportunity to work with either local or national builders, but to incent them financially to build entry-level housing, because that's where we have the most severe shortage across the country. There is nothing for a first-time home buyer to buy almost anywhere. And that's why you have a lot of buyers moving from expensive states into less expensive states, assuming that their job is portable, because that's the only way they can buy a house. I think I've told you this story before. My son got married in September. He's a teacher. His wife is a lawyer. They sat me down to ask me what states they should be looking to move to so that they eventually can afford to buy a house. Because when the median price of a home for sale in California is $867,000, that's probably not where you start.
No. Rick, why do you think local developers are taking a kind of a backseat? And you made a comment. Is it access to financing that's maybe not available to them, that it's available to kind of the more larger institutional builders?
Well, when you think about material costs, labor costs, they've gone up about 70% in the last decade.
Right.
So it's more expensive to build these properties. Labor is harder to find. Yeah. Land is harder to find. Yeah. So I think it probably is something that is more exacerbated if you're a local builder with limited funds. And right. To your point, Omar, I think financing probably is at a premium for those guys right now. They're not a national builder that can go to the markets.
Right, to Wall Street. Yeah.
We'll go to Wall Street, issue more stock and raise money that way. Yeah. So it's a much more expensive building environment. And I think that's why we've seen a lot of them back off.
So I want to end on this note, Rick. It's more the same going into 2025. Interest rates are high. Inventory is limited, although up, as we discussed today. Is there any signs that in the first couple quarters of 2025, this narrative changes at all?
I think we're seeing more interest from buyers. And when we've had shocks to the system in previous cycles, mortgage rate shocks, home price shocks, economic shocks, it's very often taken 2 or 3 years for the market to kind of settle down and then get restarted. I think we might have bottomed out in 2024. And I think buyers who might have been interested in buying in 2022 might now be kind of psychologically and financially ready to try again in 2025. I also do think that while we won't see mortgage rates fall dramatically next year, we will start seeing them settle down. That gap between 10-year Treasury yields and the 30-year fixed rate mortgage is still a point higher than it normally is. And if that just compressed a little bit, you'd see affordability start to improve. So I think the combination of more properties available to purchase, marginally better affordability, and frankly, just demand that's been pent up for 2.5 years, all are indications to me that we'll have a better year in 2025 than we had in 2024.
Super interesting. Rick, thanks for joining me. Omar, so great to have you here as well.
Thank you.
Thanks for joining. See y'all.